Welcome back, focused learners, to The Explainer. Today we're throwing a really fascinating company into what I like to call the Guru Gauntlet. We're going to run a complete top-to-bottom stock analysis on National Vision Holdings by putting on the analytical lenses of investing absolute legends, Warren Buffett, Peter Lynch, and Benjamin Graham. Then we'll run it through modern discounted cash flow models to see how it holds up today. It's a structured, no-nonsense look at what this stock is actually worth. Let's dive in. Here's our roadmap. Section 1. Company Snapshot. 2. The Qualitative Lenses. 3. The Strict Quantitative Filter. 4. Discounted Cash Flow Valuation. 5. Alternative Models. And finally, Section 6, our synthesis and final recommendation. Section 1. Company Snapshot. Let's meet the candidate. Right off the bat, as of June 2026, National Vision Holdings is trading at $18.40 a share. That gives them a total market capitalization of roughly $1.47 billion. So we're dealing with a pretty established mid-cap player here. If you don't know them, they operate under the ticker Eyewear. They're a massive optical retailer with over 1,200 locations, primarily under the America's Best brand, plus some highly specialized military stores. And their recent numbers? Really strong, honestly. Their Q1 2026 adjusted earnings per share popped over 32% to 45 cents, and revenues hit just under $544 million. They even managed to expand their operating margin to 8.3%, largely driven by smart pricing and a lot of strength in their managed care segment. Section 2, the Qualitative Lenses. Let's start by looking at this through the Warren Buffett framework. You know Buffett. He wants an economic moat, stellar return on equity, totally manageable debt, and solid owner earnings. Well, National Vision actually has a brilliant moat. They were just named the sole optical retail partner on U.S. military bases. That's huge. And their owner earnings, their free cash flow, is sitting at a very healthy $105.58 million. But, and it's a massive but, their return on equity is a measly 5.37%. That completely fails Buffett's 15% benchmark. Plus, they're lugging around almost $700 million in debt against just $68 million in cash. That leaves them with a terrifying 0.62 current ratio. So while the cash flow and that military moat are awesome, that heavily leveraged balance sheet, yeah, that would definitely make the Oracle of Omaha walk away. Now, shifting to Peter Lynch, things get really interesting. Lynch loved categorizing companies, right? As a steady retailer, they're a classic stalwart. And Lynch would absolutely love their PEG ratio, which, remember, takes their PE and divides it by their growth rate. It's sitting at 0.90. Anything under 1 indicates fantastic value relative to growth trajectory. But look at the other side of the coin, institutional ownership. Wall Street is completely swarming the stock. It's sitting at a staggering 120.68% because of short interest dynamics. Lynch always preferred stocks that Wall Street was ignoring. Because this trade is so insanely crowded, combined with the fact that Lynch demanded strong balance sheets, which we already know National Vision is struggling with, his framework points to a very cautious hold. The growth is priced beautifully, but those risk factors are just glaring. Section 3, the Strict Quantitative Filter. Enter Benjamin Graham. He was all about that defensive investor checklist and securing an absolute, undeniable margin of safety. Looking at his criteria, sure, National Vision passes the size test with its $1.47 billion cap. And it definitely shows earning stability with $46.6 million in trailing net income. But everywhere else, it's a sea of red. A failing current ratio of 0.62, absolutely no dividend record, and a trailing PE of almost 32, which completely shatters Graham's limit for a moderate valuation. But hey, let's not just stop at the checklist. Let's do the actual math. Graham's famous intrinsic value formula is the square root of 22.5 multiplied by earnings per share multiplied by book value per share. It's the ultimate conservative baseline for what a company's assets and current earnings actually justify on paper. So, extracting the data directly from their current financials, we've got a trailing EPS of 57 cents and a book value per share of $11.21. We plug those directly into the formula to find out exactly what a hardcore deep value investor thinks this thing is worth today. The result is an intrinsic value of $11.99. Remember, the stock is trading at $18.40. This means that according to Benjamin Graham's strict math, there is absolutely zero margin of safety right now. Zero. It's actually trading at a pretty massive premium to its defensive value. Section 4, Discounted Cash Flow Valuation. Let's look at the modern math. A DCF model values a company based on the present value of its future cash.
We start with their genuinely impressive free cash flow base of $105.58 million. We'll project that out using the analyst's consensus revenue growth rate, which is 6.07%. For the terminal value, what the company is worth forever after our forecast, we'll assume a conservative 3% perpetual growth. Finally, we discount all of that back to today using the company's weighted average cost of capital, or WACC, sitting at 7.42%.
Under these base case assumptions, the DCF fair value per share pops out to roughly $22. Suddenly, compared to the current $18.40 price tag, the stock actually looks a little bit undervalued. It shows that if they can maintain that cash flow machine, there is real upside potential here. But wait, look at the sensitivity of this model. This shows how fragile that valuation really is based on interest rates and risk. The middle row is our base case, but look at the bottom row. If their cost of capital rises by just 1%, which is entirely possible given how expensive that heavy debt load could become to service, the fair value drops to $18. It instantly falls below the current trading price. They are walking a very tight tightrope. Section 5. Alternative Stock Valuation Models. Looking at comparable multiples gives us a much more nuanced story. Sure, the trailing PE is a steep 31.83, but thanks to that fantastic Q1 earnings beat and expected managed care growth, the forward PE drops dramatically to 17.78. Furthermore, their enterprise value to EBITDA, which is a really great metric here because it factors in that giant debt load along with equity, sits at a very reasonable 11.82. From an operational standpoint, it's actually not wildly overpriced for a growing retail stock. And interestingly, Wall Street is highly optimistic on this one. Based on the 12 analysts covering the stock, the consensus price target sits way up there at $29.27. That represents roughly a 60% upside from current levels. Section 6, Synthesis and Final Recommendation. All right, it's time to bring all these frameworks together. Look at this master summary table. There is a massive spread in how this company is viewed. You've got Benjamin Graham's ultra-strict asset value establishing a floor at $11.99. You've got our modern DCF model sitting at $22 based on cash flows. And then you have Wall Street analysts targeting almost $30. But honestly, to get a true margin of safety that would satisfy a Buffett or a Graham, this stock would literally need to drop below $10.
Blending everything together, the picture is pretty clear. National Vision's key strength is that impressive $105 million in free cash flow, the managed care growth, and a brilliant PEG ratio. But that is fighting an absolutely terrifying balance sheet with nearly $700 million in debt and a poor current ratio. The value investing legends would scream at you to avoid it until it's deeply discounted. Modern cash flow math says it's fairly valued or slightly cheap. Therefore, our final synthesized recommendation is a firm hold.
So I'm going to leave you with this final thought as you review the data and build your own models. In your portfolio, does future growth potential and a strong cash flow moat outrank present balance sheet reality? I mean, if you believe the company can pay down its debt with that $105 million in free cash flow, $18 might just be a steal. But if that debt becomes an anchor around their neck, well, Benjamin Graham's $11 floor might be exactly where this is heading. Thanks for joining me on this explainer, and keep your learning focused.